The Dow rose 503 points in the last hour of trading alone.
All over the map. But the bottom line was this was inspired by Fed Chief Ben Bernanke, who came out and he really tried to instill confidence to the economy, to the markets, and it ended up working, even though it was a bouncy ride.
It ended up working yesterday, but let's go back to July the 26th. That's when the market downdraft started, and since July 26th, the S&P 500 is still down 13%, and if you look globally, $6.9 trillion of market cap has been wiped out. It's nothing short of extraordinary.
And treasuries have been in demand. We can't leave this out because borrowing costs for the 10-year and 2-year hit record lows yesterday. Ben Bernanke says he wants super low rates. That's what he got. Doesn't matter what S&P says. We have all the big stories covered for you around the world. Megan Hughes in Washington will name some names of who will serve on the Debt Super Committee. Michael McKee here in New York with the fallout from the Fed meeting. Manus Cranny in London, where European markets are staging a comeback. But we'll start in Tokyo with Mike Firm because Asian stocks rode the Fed's momentum. Mike?
Yeah, we saw the MSCI Asia Pac Index up the most in 5 months, but that was just a dent in the 6-day 13% drop. Economists say that China and Australia may follow the Fed and hold off on rate rises.
Almost no options, finding the one that finally calmed the markets. Economics editor, my good friend Michael McKee here to explain the new QE. Is it really a QE?
Well, there is a possibility you could get some QE out of it. Even more impressive, how Bernanke rammed this through, like when you and I fight and you always win. 3 bank presidents voted no. Fisher, Kocher, Lakota, and Plosser. First time we've seen 3 dissents since November 17th of 1992. And even though the statement said the committee discussed additional options, that opposition chose it may be very hard for Bernanke to push through a QE3.
The question is, are we going to see QE3? Goldman Sachs note came out this morning suggesting yes,
it's now
this might be
base case scenario as far as Goldman is concerned. That is the monetary side of the equation. There is still, of course, the fiscal side of the equation. And for that, the super committee charged with finding an additional $1.5 trillion in deficit cuts.
And Chairman Ben Bernanke's vote on policy. As the pressure grows on the Fed to save the recovery, the central bank may be more divided than ever. And our next guest isn't encouraged. Joining us now, Jeffrey Davis, Chief Investment Officer at Lehman Capital. It's a $5 billion global equity fund. We also want to welcome back Doug Cliggott, U.S. equity strategist at Credit Suisse. Jeff, a lot of the research notes overnight that I read suggest that Ben Bernanke is actually the hero here compared to the shenanigans we've been used to on Capitol Hill.
Well, I think that's a stretch. I think they were, you're encouraged by the fact that they really can't do anything anymore. I think some of the problems that have occurred in our economy is by an overactive Fed rather than a Fed that should be just staying the course. They've their tool bag's running shallow right now. So I think by extending out the period of which they're going to keep interest rates low, that's kind of a non-event for an announcement yesterday. But the market reacted well, so I think that's what they're trying to do.
Jeff, what is the alternative, though? The alternative would have been, I guess there are a couple of other things the Fed could have done. It could have reduced the rate.
Can the equity markets tolerate that? Capital Group, and to Doug Cliggott, U.S. equity strategist at Credit Suisse.
Now, the government is going after Goldman Sachs yet again, folks. We'll tell you what is behind this latest lawsuit when we come back right here on the Inside Track.